Hello everyone and welcome back to Churchillionaire. If you've seen my previous videos, you'll know I started with how I got scammed. Because before you can grow your money, you've got to protect it. Then I shared how to fight your debts, because before you can build wealth, you've got to stop the leaks. And after that, I made money lessons for the next generation, because it's important to pass these lessons on early. But today we're moving into one of the most important parts of adult money management: how to build your credit. Good credit can open doors: cheaper loans, better car finance, mortgage approval, even cheaper insurance. Bad credit can slam them same doors shut and keep you stuck paying higher rates for everything. So in this video, I'm going to break down how credit really works, how to start building it from scratch, and how to rebuild it if you've already made mistakes. There's no jargon, no nonsense, just real life, real talk, real cash. And honestly, this is one of the biggest requests I've had so far. People keep asking me to talk about how to actually build good credit the right way. This video is all about the foundations, the basics that everybody needs to get right first. Once you've mastered these, we'll move on to more advanced ways to build credit and how to boost your credit even faster. So let's get into it. Understanding when credit starts. Before we get into things like getting on the electoral roll or using credit cards, let's talk about age, because a lot of people ask me, when can you actually start building your credit? In the UK, most credit activity officially starts at 18, because that's the age you can legally sign an agreement. But that doesn't mean you have to wait until your 18th birthday to prepare. Hopefully by the time you're 18, you've already got your own bank account. Having your own account is one of the first real steps towards building your credit. It helps you get used to managing money coming in and out. It shows your bank you can handle your cash, and it builds trust with them over time. That applies to everyone, whether you're just starting your financial journey or rebuilding after a rough patch. If you haven't opened a proper bank account yet, make that your first move. It's simple, free, and it gets the ball rolling. In a video coming soon, I'll be talking about which bank accounts are worth opening, which savings accounts give you the best deals, and what type of credit cards are the best to start with. So make sure you subscribe so you don't miss it. And I'll also be covering how linking your bank account to your credit file can actually give your score a small boost. Get on the electoral roll. Once you've got your bank account sorted, the next thing you can do, whether you're young, studying, or well into adulthood, is get yourself on the electoral roll. It makes a massive difference. This isn't just for 18-year-olds signing up for the first time. Plenty of adults, including myself, didn't get round to it until much later. But it's one of the simplest and most powerful ways to help lenders confirm your identity and your address. If you're not on it, you're already starting one step behind. Even if you have decent credit score already, get on it, because it will boost it. So it doesn't matter how old you are, just get it done. And just to show how important that really is, being on the electoral roll can actually count for around 10 to 15% of your entire credit score. That's roughly 100 to 150 points on the experience scale, all just for confirming your identity and address. And it's one of the easiest things and easiest wins you'll ever get. Build smart even without big money. If you've already turned 18 and you're earning, or even if you are on a lower income, start small. A mobile phone contract in your name is an easy way to start building credit, as long as you pay it on time. A simple SIM-only plan is often enough to start a history of regular payments. And if you're just starting out, studying, or maybe rebuilding after debt, a great tool to consider is Lockbox. Lockbox isn't just for young people, it's for anyone who wants to build or rebuild credit safely without risking debt. It works like this: you choose a small amount that you can afford to save each month, maybe 20, 30 or 40 pound. Lockbox locks that money away for a year, reports each monthly payment as if it was a loan, and then it gives you all the money back at the end of the term. So you're saving, you're proving you can make regular payments, and you're building a solid year of positive credit history all at once. It's perfect for people who might not have much income yet, like students or part-timers, but it's just as useful for adults who are rebuilding and want a safe way to restart. And with Lockbox, it doesn't matter whether you save 20, 40 or £100 a month. The amount doesn't affect what score you'll end up with at the end. What matters is showing that you can make those payments consistently and on time. That's what lenders really want to see: reliability. So I'd suggest starting with a smaller amount, because there are better places to save larger sums of money where you'll actually earn more interest on your money. Again, I'll touch on them things later on and talk about bank accounts, saving accounts, etc. Piggybacking. Building credit through someone you trust is another way to build credit fast, especially if you're starting from zero. By piggybacking on someone else's good credit, this means that you're becoming an authorised user on maybe a family member's or a trusted friend's credit card. Here's how it works. If they've got a good, well-managed card, always paid on time, low balance and long history, you can ask to be added as an authorised user. That account then appears on your credit file too, giving you the benefit of their good history. But here's the key, make sure it's someone responsible, because if they miss a payment or run up debt, it will affect your credit too. And you don't even need to use the card yourself, you just need to be added to the account. It's one of the fastest, smartest, safest ways to start showing positive activity on your credit report, as long as you do it with somebody that you trust. Getting your first credit card. Now that you started to build a bit of history, maybe through Lockbox, a phone contract or piggybacking, the next big step is to apply for your first credit card. For most people starting out, that will be what's called a credit builder card. They're designed for beginners or people rebuilding their credit. They often come with a smaller limit, maybe £200 or £500. And yes, the APR and interest can be slightly higher, but here's the key, the APR doesn't matter if you pay off the full balance every month, because if you pay it in full and on time, you'll never pay a penny in interest. The goal isn't to borrow money, it's to show lenders that you can handle it responsibly. So use it for the things that you'd buy anyway, like your weekly food shopping, your phone bill or a monthly subscription, and then pay it off straight away. Credit utilization. Once you've got your first credit card, how you use it really matters. That's what we call credit utilization, and it's one of the biggest factors that shapes your score. Let's say your card has a limit of £500. Try not to use 30% of it. That's roughly £150. Shows lenders you're responsible and not relying too heavily on borrowed money. Using too much of your limit or maxing out cards make you look risky, even if you are paying on time. Now, if you want to take things further, the real sweet spot for utilization is actually closer to 10%, but we'll get into that in an advanced video soon. For now, just focus on staying under 30%, keeping payments on time, and using your credit card for things you already buy, like food shopping or subscriptions, so you're not spending extra just to build credit. Income and responsibility. Something people always ask me, do I need a full-time job to build credit? And the answer is no, not to build your score. You can build credit with a part-time work, self-employment, or even while studying, because the main thing lenders want to see is consistency, that you can make payments on time every time. But when it comes to getting approved for bigger things like loans, car finance or mortgages, your income does play a part. The higher and more stable your income is, the better your affordability looks, which can help you qualify for better limits and lower interest rates. So yes, you can build credit without much money, but as your income grows, your opportunities grow with it. Showing you can manage money, affordability basics. Once you've got money regularly coming into your account, whether it's from work, self-employment or even benefits, the next step is showing that you can manage what you've got. Lenders don't just look at how much you earn, they look at how you handle it. That's called affordability. A good trick is to always try and leave a bit of money in your account at the end of the month, even if it's just £50 or £100. When banks and lenders check your statements, they see your ingoings and outgoings, and if you always end the month with a little left over, it shows you're in control, not living paycheck to paycheck. This doesn't just help your credit applications, it builds a habit of saving and discipline. You're proving that after all your bills and spending, there's still some money left over. And again, in a future advanced credit building video, I'll show you a few smart ways to take that even further, like timing your payments and using accounts strategically to make your finances look even stronger on paper. So let's have a quick recap. What lenders actually look for. Now let's really break down what lenders look for when they decide whether to say yes or no, because understanding this is what turns you from guessing into knowing. So number one is your identity, address and stability. Being on the electoral roll proves who you are and where you live, and that one alone can add up to 10 to 15% of your credit score. Lenders want to see stability, staying at the same address for a while, keeping the same job or even using the same bank account for your bills. All that quietly builds trust. Your credit history. Your credit history shows lenders how you've handled money before. They look at things like, have you made payments on time? Have you missed or been late on any? How long you've had your accounts open? Even small things like paying your phone bill, lockbox or streaming subscriptions on time all add up to build a solid payment record. Affordability and income. They check how much money you've got coming in versus how much goes out. That's why even small regular income helps. As your income grows, you'll naturally become eligible for higher credit limits or better deals. Employment and stability. Lenders love to see stability. If you've been in a job for a while, that's a plus. If you're self-employed, they might ask for proof like bank statements, which is totally normal. And if you're not working right now, don't worry, smaller things like phone contracts or the lockbox, as I keep mentioning, can still build your track record. Recent applications. Every time you apply for credit, it leaves a hard search on your file. A few are fine, but lots of them close together can make lenders think that you're desperate. Space them out, it shows control. Number 6, your credit mix. Lenders like to see you've handled different types of credit, a phone contract, credit card, maybe a small loan. That variety shows experience and balance. So when you put it all together, lenders aren't just looking at a single number, they're looking at your story. They want to see consistency, reliability, and control. You don't need to be rich to have good credit, you just need to be responsible, predictable, and patient. How to build your credit score step by step. Number 1, start small. Use something simple like a SIM-only contract, a Netflix or Spotify bill, or a low-limit starter credit card. Pay it on time, every time. Keep your credit usage low. If you've got a £500 limit, try not to use more than 150 or 200 of that. Keeping it under 30% shows you're in control. Step 3, pay in full. Don't just make minimum payments, pay off your balance in full each month. Step 4, avoid quick loans and payday lenders. They might give you money fast, but they scream high risk. Number 5, be patient and consistent. Building credit takes time, small regular actions, not shortcuts. Final thoughts. So yeah, remember, credit isn't bad, it's a tool. If you use it properly, it can work for you. Whether that's getting cheaper car finance, mortgage, or even using low interest credit to start a business. But used wrong, it can trap you in debt and stress. And in a video coming soon, I'm going to take things up a level. We're going to go deeper into how credit really works behind the scenes, like the difference between soft checks and hard checks, and how each one affects your score. We'll also talk about how to use multiple credit cards a smart way, because believe it or not, having more than one credit card can actually help your score if you manage them properly. I'll show you how to optimize your credit utilization, make your cards work for you, and even earn cash back while improving your credit at the same time. And yes, we'll look at the famous 15-3 rule, a clever trick for timing your credit card payments to make your report look its best. So if you haven't subscribed yet, make sure you do and turn on the notifications, because you won't want to miss that one. And don't forget to like, comment and share this video if you've learned something new today. It really helps the channel grow, and it also helps other people find this information too. This is Churchillionaire with real talk, real life and real cash. Thanks a lot. Just to be clear, I'm not a financial advisor. Everything I share is based on real experiences, research, and the same strategies I've used myself. Always do your own checks before making financial decisions.